I do, my friend. Thank you
Good.
very much. And good morning, good afternoon, good evening to all of you around the world. I hope you guys are having a safe and fun holiday weekend here, meaning that you're here with us, not in the shopping malls battling the crazies. So with that being said, let's get right into this because we have a lot to cover. Now, Hubert did just go ahead and cover risk, so I won't spend a lot of time on this because we got a lot to do in 45 minutes. Yeah, it's definitely consult registered financial representative in a risk trading plan before ever trading anything. Now, this strategy I'm going to share with you today is going to be very near and dear to my heart. Here again, I use it almost every day, whether that's to either get into a trade, get out of a trade, or to avoid a trade. Or know that I should continue with the trade. And this week, shining example of a place I avoided a trade initially, then went on to make money with it, but avoided the initial trade because of this specific strategy. You need to know this stuff, gang. I share it all the time. I've written about it in lots of different trading magazines and journals. Everybody's always focusing on it as a trade entry strategy, but it's so much more, okay? And yeah, good morning. That's very nice of you guys. Thank you. Just one little thing. I, like Hubert, am sick, and don't start rumors, but we're both sick, and we've both been sick right about 2 weeks, his family and my family. So it's been 2 weeks today was when I first broke down and ended up winding up in bed. So just bear with me. I'm going to have a little bit of cough here and there. I'm just having a hard time shaking it because I keep talking to you guys. So with that being said, though, this went ahead and identified. We're going to talk about this from so many different levels, multi-time frame signals, how this competes with using volume to a degree. But what happens when you have really great indications out there, but you see these, a lot of stuff we're going to cover. So with that being said, knowing some of the proper setups to even consider a trade, identifying precise entry prices for your trades, simple technicals that will help you identify the direction, and then some of these key ahas, putting several of these things together is what we're going to hit with this. And then I'm going to try to mute the microphone where I can so I don't cough in your ear. So this could be used to get in, stay in, get out, or stay out. That's part of the real key here to this whole process. It's not just a get in type system, so it's really cool. I don't have much time to talk about myself, but my website is becomeabettertrader.com. Been featured in a lot of different filmings at a lot of the exchanges, and in fact, I just did some more interviews, not for the exchange itself, but other interviews about Bitcoin futures that are coming out here soon. So a lot of great stuff. Been putting a lot of different articles around the world, including some of the stuff we're going to talk about here today, except I'm going to expand on it for you much better. These trading competitions, some of these are one-on-one competitions for a short amount of time. Others are like big, up to 16 traders for 12 hours, and so sometimes people don't understand just how intense these are, and I've won the vast majority of these, so it's not just dumb luck. That's why these strategies that are constantly in play during these competitions are really important to you as well, and why it's great that you guys are here. So in summary, as Hubert said too, I really trade. That's important because having a simulator account or not showing your trades on a screen doesn't really count. And don't worry, I have nothing to sell you today, but I will offer you guys to come visit me in my live trading room. I'm doing less and less of those to keep focused on my students in the trading room. But this coming Tuesday, my birthday, we are going to actually have an open house. And so you guys can come watch me trade this Tuesday. So I have nothing to sell you, but we got some great stuff for you. So with that being said, what is this? This is a price action based trend continuation trade. Right? When do we use it? It's most effective in trending markets. How do we identify it? Looking back over the last 20 periods, okay, the time frames you're looking to trade, we're looking for these things called signal bars, and that's where the open and the close are approximately 45% or more off the high in an uptrend, or 45% or more off the low in a downtrend. And by the way, those of you that are already starting to ask questions, I'll try to hold questions to the end, or you guys can come visit me this Tuesday morning live, where we'll have hours together in the live markets to execute trades and answer questions as well. So feel free to write down your questions. We'll get to them one way or the other. So basically what we're doing is we're asking ourselves, how much wick is showing? Is it approximately 45% or more? So this is what we're looking for. In a downtrend, I'm looking for these bars where the institutions have not only stopped the market from going down, but they've actually driven it back up. All right, but that's just one or more institutions. Now, then from there, what we're looking for is the market to push back down through here for a continuation. We'll talk more about that in a minute. But like here the other day, and that's the chart that I was just showing you a moment ago, I was identifying bars where the market not only stopped going up, but it actually pushed down. Now that's going to be real important as I show you then this live example from the other day. On a trade I avoided, then I turned around and got into a trade. So we'll tie this all together for you at the end. All right, so that's what we're looking for. In an uptrend, we're looking for bars 45% or more off the high. In a downtrend, 45% or less off the bottom. And again, that's on the time frame you're looking to execute a trade. So if you're, whether it's daily, weekly, or intraday charts, anything 2 minutes or above, gang, anything 2 minutes or above. So I don't use this on 1 minute or 10-minute charts. The entry, where's the entry? It's typically 1 tick, 1 cent, 1 pip above or below that signal bar. So we identify the signal bar in a downtrend. Basically what I'm looking for is where that one or more institutions no longer has that inventory to trade, and now the market's free to go back on board the original direction. So it breaks 1 tick, 1 cent, 1 pip below the low or above the high of that signal bar. Okay, so in a downtrend, I want it to break 1 tick below. In an uptrend, I want it to be 1 tick above. By the way, these are 4 individual unique examples. So I just want you to see it doesn't matter whether it's more of a doji star, whether it's got a small green body, a big green body, or red body. What matters is there were 45% off the high in an uptrend or 45% or low in the downtrend. Where's the exit? I'm a big fan of trailing trades. That's one of the biggest changes in my success, where I had a big loss years ago where I actually had a profit on the board, but I ended up being a jerk on the trade, wanting more money, and then it turned around and I had big size on, and economic data, or not scheduled news, but some comments from the Fed came out and turned my trade into a big loss when I actually had a profit on the board. Back then I wasn't trailing my trades like I do these days. So talking about my trailing stop methodology, 50, 80, 90 price. I want you to think 50, 80, 90 price, because this also went on to help me win a lot of these competitions around the world as well. So first of all, we go ahead and we identify a target out into space. That can be daily, weekly, monthly pivots, key support resistance levels like 50, 50 or 200-day moving averages. Could be perhaps like a point of control. There's a lot of different places that you could use for key support resistance levels. But what we do is we start here with this target out in space in mind. Once we get, and that equates to roughly about here for the purpose of this example. So as we get about 50% or more to the way to the actual target, we start trailing by 50% of profit earned, okay? 50% of profit earned. Now, as we go ahead and get about 80% of the way to the target, we start trailing about 80% of profit earned. As we get up near the price, okay, so now you get up to the target, 1 out of 10, 1 out of 12 times, maybe even sometimes more, depending on the markets you're trading, it will pop up through that key support or resistance level, especially obvious ones like high of the day, high of the week, things that everybody watches and gets themselves suckered into. And so what will happen is, if it does pop up a little bit higher, then we'll start trailing it up 1 for 1. But initially, when it gets to the target, trailing it up by about 90% of profit earned. Why? Because what's more likely to statistically happen? Is the market more likely to stop and reverse, or is it more likely to keep going? It's far more likely to stop and reverse. All right, so we're trying to lock in the majority of that profit. And then if we get it up there, it's at 90%, it still just won't break through that level. Just moving it right up to the price and waiting to be taken out, from my perspective, is best. All right, stop loss. 1 tick, 1 cent, 1 pip beyond the low or the high of the signal bar on the opposite side. Or for back testers, those you that can go back and test your favorite stocks, depending whether you have a high volatility or low volatility trade, got a little secret for you. So so officially, remember now, in a downtrend, we're looking to short 1 tick, 1 cent, 1 pip below the low of this bar. Excuse me. However, the official stop loss is 1 tick, 1 cent, 1 pip above the high of this bar. Now, that's especially if you have a high volatility stock. Okay, if you have a high volatility stock, then having a wider stop loss makes more sense. If you have a lower volatility stock, then even if it goes back more than 60% beyond of the bar against you, then it's more likely to actually go all the way to the full stop loss. So what you want to determine is the volatility of the stocks you like to trade, and ask yourself, is this in fact a high volatility, low volatility stock? And if it's a high volatility stock, then I probably want to keep the stop a little bit wider, because otherwise I run the risk of it pulling back, stopping me out, only to come right back down. But if it's a low volatility stock, usually if it comes back that much, it's more likely to go all the way back there. So little secret for you guys. Then the opposite is true. Remember, in an uptrend, we're looking to break 1 tick, 1 cent, 1 pip above the high here. Officially, the stop loss is back behind here. If you have a low volatility stock, though, and it goes more than 60% back against you, it's more likely to go all the way. So keep those two different variations in mind. You can back test it on the stocks that you go ahead and prefer to trade the most. Okay. Now, a couple things to remember. If you think about the concept of rocket fuel, if it's moved a large range quickly, the breakout is at least likely to temporarily fail. What we're talking about is this kind of bar right here. If the bar you're looking to trade these accumulation bars off of is 2 or 3 times, especially 3 times or more, the normal average true range of the last several bars prior to this bar, then you're usually going to have some problems. Here's what's going to happen. Because remember now, the official entry in this particular trade based on this one particular setup is right down here at the bottom of this bar. Well, so now if this market's got to go all the way back up here, but then our entry for this particular trade is all the way back down here, that's using up a lot of energy just to get to the breakdown point, and then it's still got to keep going to make money. What usually happens in a situation like this is that the market will, when it comes back down here, use up a lot of energy to get down here. Then it will start to bounce, and then may even have a secondary bounce, kind of what I call skipping rock theory, before it would finally break. So that can be very, uncomfortable for people to sit through, or just an unnecessary thing for people to sit through. So I would strongly encourage people to, potentially avoid these ones that are 2 or 3 times the average true range before you get into them. This kind of stuff here, especially if the bars before it were basically roughly equal size, are the kind of things that we're looking for. Now, this has very diverse applications, though, whether you're stocks, futures, options, forex trader. This can be used, from my perspective, in any of these markets. Okay, for options, you're looking at the underlying instrument, equities themselves. Futures, forex, you trade in the actual instrument themselves. So anything 2 minutes or above for the time frame, and stocks, futures, options, forex. Okay. Now, trail your entry to reduce the risk of reversion of the mean. This is not just about this setup, gang. This is pretty much every setup that I do. So I've become an advocate over the years, after several years ago having a large unnecessary loss that was strictly because I wasn't trailing. It was a total profit turned into my largest loss because I didn't go ahead and trail. So it was a great opportunity for me to develop several years ago, and I share it passionately since then to help people all over the world with it. All right. Trade in the direction of, disregard the first part here. It says BBT Pro Trader Pack. Those of you that have it, great, then do it. Those of you that don't, use something like a simple 20-period exponential moving average that's 45-degree angled over the last 20 periods that you're trading off of. Okay, so that's what you're looking for here. So like in this example, we're looking at the last 20 bars of data, and we're looking for that 20-period exponential moving average to go ahead and be in approximately a 45-degree angle. That's the most sustainable. That's why we like to go ahead and see that. So 20 periods, 20 bars, okay, with 20-period EMA. Now, here's a list of all these different rules back to back one more time. So in summary, what we're looking for is this bar, and so we're talking about entries right now, but I'll make sure I'm going to let you know how to use this to help avoid trades. I'm going to show you that in just a few moments, how to continue with trades and that. So there's a lot of different great uses for this particular strategy. So in summary, in a downtrend, we're looking for these bars that are 45% or more off the low, where one or more institutions has not only stopped the market from going down, but they've actually driven it back up. Again, that's institutional activity. It's not you or me that's going ahead and actually making that happen. So that's why it's so important to note this kind of thing happening. Now, in an uptrend, we're looking for an entry 1 tick, 1 cent, 1 pip above the high, where the market's been pushed down initially, and then that inventory is used up by that one company, that one firm, and then now the market's free to go back on board the original direction. Just remember, stop loss for low volatility stocks, approximately 60% back here. Officially, it's 100% back behind your test based on the volatility of the stocks that you like to trade. And this is also not a 4-bar pattern. These are 4 individual unique examples. All right. Now, so I always like to, years later, I still like to show this, even though I use this every day. I have new examples. In fact, I'm going to show you an example from just the other day. It's a very powerful example of using this in action in one of the different ways that I use it. Excuse me. But what's important to understand here is I like to show this one because I still show this to both my retail and institutional clients. For those of you who follow my free nightly videos, we go ahead and we talked about this live as this was happening. I like to use examples I shared publicly. So with that being said, here you can see that bar 45% or more off the low in a downtrend. You can see the 20-period moving average beautifully coming down here. Again, disregard all the other cool stuff. That's, for today's purposes, we're using the price action and a 20-period exponential moving average. So notice what happens after that accumulation comes in. The market actually goes up 1 week, 2 weeks, 3 weeks. Week 4 and week 5, it sat there. There was so much inventory to accumulate, that actually sat there for 2 weeks. Now, once that inventory let up, though, this thing dropped like $30 the next week. Okay. Now, the question that I always get from this is, well, can we take more trades and we see more signals? And each trade is basically taken on its own merits, one at a time. The trend is your friend till the bend in the end. The longer the trend has been going, the more likely it is to reverse. So I don't want to get heavier and heavier and heavier with my size as it's going down. If anything, I'd rather be heavier up front, okay, and just take a heavier position when I get a signal early on, rather than adding in more and more contracts when it's more and more likely to reverse. Because otherwise I get my cost basis real heavy down here, only to have it push back and then take a really great trade, where if I would have been heavier up front and then benefited from it, rather than get heavier at the bottom and where I'm more likely to have the reversal. So I hope that makes sense to everybody. So each one of these is taken on their own merits. It's taken for the size you want to put into it, and then trail the trade. Obviously, coming down near round number supports or resistance levels, key obvious areas. Those you saw my free nightly videos. I gave that really great idea here recently on Tesla at $300 because a big key round number support level. Sure enough, it did bounce up roughly $18 over the next several days, and people really like that. So those key round number supports and resistance levels, important to know. Each trade is taken on its own merit. So if you take the trade here, notice that it sat there for 3 more days. There was so much inventory by that one or more institutions, but then when it dried up, then the market was free to whoosh on board that original direction. But if you got stopped out along the way, because like here, this one de-jerked back pretty good, that's okay. You just wait for the next entry opportunity as long as you still have the trend. Okay, that's real important. Lots of different opportunities for these. So here's some actual examples I use, like in the big international competitions over in Paris, where you have like the 16 traders that goes down to 8 traders, that goes down to 4 traders, that goes down to 2. Sometimes people say all those trading competitions are just for show. The reality is, especially those big international ones, those are big deals, and so even the smaller ones, you have one too many of them to be a coincidence. These are some of the actual strategies that I used during this. So let's take a look at some of those. So right here you can see the market was starting to come down. We had one of these bars that was 45% or more off the low in a downtrend. And what did I do? I went ahead and went short right down below there, and then look what happened over the next few minutes. This market actually whooshed to the downside. And the reason why I keep focusing on that whoosh is because that's the expectancy. The expectancy is once that one or more institutions is no longer there with their inventory, then now the market's freed with vigor to go back on board the original direction that it was going. That's why I'm focusing on that whole whooshing factor with you here, gang. So here's another example, and this is also nice for a couple different reasons. Now, this was on an intraday basis, but I want you to think about this even if this were a swing trade basis. So here's what happened. So the market was coming down, and I had one of these signal bars. Now, with these big international ones, you got all these judges standing over you. They're validating, verifying each one of your trades. They're not messing around. It's a pretty big deal. And what happened was I was able to then identify well in advance, hey, gang, I'm putting an order out here because we had the signal. We had the downtrend. We had the 45% off the low. Well, look what happened. It took about 18 minutes there for this market to push back up, pull back down, and once it broke down below my signal bar, what did it do? It whooshed to the downside. So I was able to put that trade out way in advance. Now I want you guys to think about this from a swing trade or options perspective for a moment. If you have your favorite underlying equity, you identify that setup. Okay, you can always go ahead and put on one of your favorite option strategies to go ahead and take advantage of that, or set up an order to perhaps sell the underlying equity. All right, so there's lots of different things that you can do with this, whether you're a intraday or end of day trader. Does that make sense to everybody? Okay, awesome. So as we go ahead and look, and then there was another one that was right over here, and that gave another short. You'll notice that after each of these, the market started to have these little whooshes down thereafter. I won't have time to go through all of this right here like I would normally want to. But what I will say is that there's a lot of institutional versus retail mistakes that we're trying to deal with here. So we're trying to get a lot of these retail trader mistakes covered and addressed. And this particular strategy really helps people to, on the buy side, helping to, because what's normally happening is the buyers being distracted from wanting to buy or giving sellers false hope, and stopping out late buyers. On the sell side, it's just the opposite, and this setup is completely designed to deal with these issues. And normally I'd like to break these down here, but just understand that these are the types of shortcomings that on the retail trader side I'm trying to address. Okay, now as we go ahead and take a look here, here's another live trade that I took. So the market was coming down, and the backdrop's a little bit hard to see, but you can kind of see the overall trend was coming down here. The market was 45% or more off the low, and look what happened after it broke down below here. And this is the middle of the night U.S. time, France time, is where we were. So what happened was after this broke down below the low here, it whooshed to the downside, and that's the expectancy. Once that one or more institutions' inventory is dried up, the market's free to go back on board that original direction. Okay, so now as we go ahead and take a look at this, does this start to make a little bit more sense? So going back to this original example, now we see the market is in a downtrend here. We're looking for these bars that are 45% or more off their low in a downtrend. And then what we're doing is looking to get short once it breaks down below. But it's so important to understand, until it breaks, it's a key support resistance level. And I'm going to tie that in with you after I share a couple more how-tos with this in just a few minutes. But that is so important. Once that inventory is there, you can see multiple examples of it as it was taking place. This time frame here matches this over here. So we were getting a weekly and a daily accumulation accumulation bar, IRB accumulation bar at the same time. And you'll see in both cases, basically that market stayed there. In this case, 3 days. Then when it finally broke down, it whooshed to the downside. Here, it was several weeks. And when it came back down, it stayed there. There was so much inventory. This is institutional game. This isn't retail. We need to follow what they're actually doing. This is one of the best ways to do it without having to use a whole bunch of fancy tools and indicators. All right. So this is after Apple split. For those of you that have been watching my videos over the years, you recall once Apple split, I then was showing the opposite side of this. So we were looking to make $100, round numbers, support. We finally got it. Started taking off here. Can you guys see now the distribution bars up over here? So that's where we're coming 45% or more off the high in, as you can see, this beautiful 45-degree angle type sustainable uptrend, right? So what do? We go long, 1 tick above the high. Stop loss is 1 tick below the low. 1 tick above the high, 1 tick below the low. The high, the low. The high, the low. Okay? That's where the stop losses are. All right? And then the entries. And you'll notice that each one of these did a very nice job. Okay? This bar here opened up, went down, then it came back up. Once it went back above, didn't come back down. So these were all very nice examples of this in action as I was pointing them out to you in those nightly videos. All right? So really, it's a nice strategy that people need to go ahead and be aware of. All right? Excuse me. Sorry, a bunch of us are sick here today, so bear with us. So here's another great example. I was just teaching this over in Barcelona, Spain, and then the trade happened. Now you can see this. This is a nice combination of those of you that are familiar with multiple aspects of my work. Those of you that aren't, come watch me trade live, for free on Tuesday morning. You can get more familiar with my work. We had this really nice retracement here. This was a stochastic spike trade, but right after the spike trade, we went ahead and we had the inventory retracement bar. Can everybody see it? You got that beautiful 20-period exponential moving average coming down over here. You got that bar that's 45% or more off the low in a downtrend. There's your stop loss, 1 tick, 1 cent, 1 pip. And so what's nice is this whole thing was happening up here right after I was teaching these concepts, and I was able to go short. And of course, people always love making money after doing something like that. So, and then you see what happened though is it really picked up steam after it got down below that IRB and whooshed. So this is a great example of those retail traders, being spooked. The traders who didn't go ahead and short up here when it was slowly coming down, they get short down here and then stopped out as it pops back up, only to watch it go back down their way. The people who went long up above get this false hope that it's going to keep going up their way. Meanwhile, I'm just waiting for it to come back down below the institutional level for a short. A lot of these different things that are happening, to traders, and that's those institutional versus retail mistakes that we were talking about, which is why we use this to help avoid some of those. So key points to remember: trade with a reasonable trend. The more shallow you make the trend, the lower the probabilities of success with this trade or any other trend trade. I had a situation out of California that really exemplifies this. So what happened was I was teaching a class in California. Several months later, I went ahead and was back in contact with the students. Like, Rob, what's going on with this strategy? It's just no longer working. And I'm like, I don't understand what you mean. I've been winning all these competitions and stuff, using in my trading room all the time. I don't understand. And come to find out, what was happening was things like this. So you'll notice in this case, the 20-period exponential moving average is basically sideways. So here you'll see this one had an accumulation bar. If you push down below it, it still worked. This one then had an accumulation bar. If you went short below it, it worked. Same thing here, same thing here, same thing here. So basically what this person did was they saw that even with a shallower angle, what they could do is they could get more trades and more trades and more trades. The shallower they made the trend, the more trades they could get. But if it's a trend continuation trade and you've given up the trend, what are you more likely to have? More stop losses, exactly, right? So So that's what happened. Basically, this person was like, well, yeah, but I got a lot more trades. Well, yeah, but then you got a lot more losses, right? So again, stick with approximately a 45-degree angle. That's the best for trend continuation. Yes, you can shallow it out occasionally, but don't let that lead to bad habits where next thing you know, you're basically using this in a sideways market. Make sense, everybody? So that's lesson number one that a lot of people need to know. Beyond that, so again, yeah, nice trends. Those tend to have the best continuation trades. Right now, key point number two or more IRBs back to back or within 2 bars of each other, it can spell trouble for your trend continuation. So consider tightening a trailing stop, backing off of a trade. Okay, here's a great example that we're actually going to follow up on this stuff in a few minutes. So here you have the market coming down, but notice that also you had 2 IRBs back to back, change the trend. Here you had 2 IRBs back to back, change the trend. Here you had 2 IRBs within 2 bars of each other, so that's why it's back to back or within 2 bars of each other, and change trend. Here you had 2 IRBs back to back, change the trend. You guys see the pattern there? Now, an IRB appearing on multiple time frames at the same time dramatically increases the likelihood of a market reversal. I need you guys to really pay attention to this. It looks like you guys are doing a good job and are very active in responding. I want to make sure you guys really see this. I want you to look. This is a 2-minute, 5-minute, and 15-minute chart back to back. Okay, and what you'll notice here with this is that what's really happening is that we're seeing the same distribution bar. Now I have it highlighted here, but hopefully your eyes were kind of drawn to it as is. So here, there's a distribution bar. Here is a distribution bar. Here is a distribution bar on the 2, 5, and 15-minute chart. Now you'll notice here, basically, this market never looked back. It went in ahead and it rallied back up to the bottom end of the channel, which is resistance once that channel of distribution is formed, because as soon as it got right back up there, then that's a great natural place for this to roll over and die a horrible death. So when you have multiple time frames together, this is going to tie in. When I started the webinar today, I showed you an example of how we used this the other day to avoid a loss and then actually get into a winning trade in my trading room, which hopefully I get to do again this coming Tuesday when you guys join me for the free event. And so what happened was the market rolled over, and I'm going to show you crude oil in just a few minutes from the other day's example again. The other thing to keep in mind, the entire band of an IRB wick is key support or resistance until broken. It can be, and then it can be used as a likely reversal point for a market trend. This is real important. I actually won one of my trading competitions out in Las Vegas, and for anybody in here at that time that was there, you recall I was going up against this gentleman. He had a lot of laptops and computers with him, and what happened was I had a situation similar to this. The market had gone up, it formed one of these IRBs, pulled back into rising support. I went long. Then I announced to the entire audience there that, hey, listen, I'm going to go ahead and actually close out this position because I have this thing called IRBs, and that's a proven distribution resistance area. So I don't want to hope, wish, and pray that it's going to keep going my way. I've made money on the trade. It's coming back into the distribution. I'm going to go ahead and close out the position. Well, I did, and then sure enough, the market stopped and rolled over. So much same type of thing, like with this example here, it's the same thing. Once these distribution bars are formed, what's real important to understand is that they are now a big, fat, proven resistance level where one or more institutions has not only stopped the market from going its direction, but has actually backed it off. So notice what happens here. Then it gets back up into that area, gets killed off, gets back into that area, gets killed off, touches the bottom end of the area, pulls back, gets back up into that area one more time, and then gets killed off, never to look back the rest of the day. And interesting to note, after this had happened at that time in gold, the market actually went down for quite a while, several days afterwards. So again, what's important to understand, this isn't some retail gimmick, retail trick. This is institutions voting with their very big dollars to not only stop a market from moving its direction, but actually temporarily reverse it. You need to pay attention to these, gang. So here's what happens with these. So notice here that this market, here was an inventory retracement bar that was formed. Now look what happened afterwards. The next bar stopped at that bottom end of the level. Next bar stopped at that bottom of the level. Next bar stopped right in that level, came back down. Okay, now when it came back down, it actually formed its own distribution bar. So now look what happens. Okay, market pulls back up into that area, gets killed off for quite a while. Finally rallies all the way back up there, right where the bottom end of that distribution bar started, gets killed right back off again. Okay, very powerful. One or more institutions had so much inventory to liquidate up there, and you could spot these in advance. All right, now, then over here, you can see another one of those distribution bars formed, and as of the time of that bar, it had never gone ahead and broken through there. Okay, so the entire band of IRB wicks are key support or resistance levels until broken and can be used as excellent likely reversal points in a trend. That brings us back to the other day. Okay, this is really important. So what happened was, all right, all of a sudden we had this big, first of all, if you guys have been watching my videos, have I been very bullish or bearish? We'll see how many of you guys watch my nightly videos. How many of you on my free nightly videos that you guys, everybody here has access to, how many of you have I been bullish or bearish crude oil? Absolutely been bullish. Absolutely been bullish, right? So we were looking to get above 50, and then from 50, I've been saying we could easily get to 60. So what happened, we've got all sorts of great indicators. My champion setup indicators firing off, a lot of green, a lot of trend continuation, breakout continuations, whole bunch of my strategies firing off there, right? And then we pulled back into rising support, broke right back above with my champion setups, firing off here again. Absolutely, exactly. People are saying bullish, Rob, from 50, exactly. So all right, so we've been very bullish. But here's what all of a sudden I noticed the other day. So we had this big wide range bar right here on 15,000 contracts. But then all of a sudden we had this bar up here which had 7,500 contracts of volume. And this is a live screenshot in the morning from the live trading room that you're looking at here. Okay, so you see my champion setups and stuff and some of my starter package of indicators in there and stuff. So all of a sudden I'm like, wait a minute, 7,500 contracts with a distribution bar. If that was all buy side, this should have been actually up here more. So we were seeing, institutions start to sell into this area. So I backed off of looking for long side trades, and then you'll see here as well. There's that distribution bar on the 2-minute chart. But can you guys see the same distribution bar on the 5-minute chart? Can you see the same distribution bar on the 15-minute chart? We had multiple time frames. Remember that little lesson that I just taught you a few minutes ago with some other slides? You guys see it? So this thing went ahead and went down, and it was very nice. And so this offered up some really great opportunities then to go ahead and trade. And what was happening, I told people this too. I'm like, you know what? I think what's happening is they're buying big blocks, they're selling some, and then they're coming back and buying a bunch more. Because like over here, we had 15,000 contracts again over here. I said, I think they're accumulating the heck out of this thing, even still at the $57 mark. And so I went long as well here. And sure enough, that was live on the screen in front of people in the live trading room. Sure enough, this thing did go up. Last time I checked, it was at 58 and change. So this thing is, just continuing to plow ahead, almost hit, that $60 target the last time I checked. So really nice stuff. And you can see here that kind of a culmination of a couple of different examples that we went ahead and we talked about different types of things. with the distribution bars, multiple time frames, why I was so bullish the last several weeks on crude oil. Thanks, Mike. Yeah, 58.70 real-time quote there from Mike. Thank you very much. So close to my target, but you guys can see in the bigger picture why I was bullish. You can go ahead and see it. By the way, this broke another one of my distribution bars up over here. You can see the distribution bars, and then pushed above that, got up to 58.70 now. Lots of distribution bars. Can you guys see that distribution bar? Broke above that, whoosh to the upside. You guys see this? This is real. I can't make this stuff up. This is the real deal, gang. And this is one of those strategies amongst several that I go ahead and use to help me win these competitions. It's not pure luck. I win the vast majority. I only lost a handful of them, and I've won 25 domestic and international. There's a reason. This is one of those strategies that can help you. So I wanted to look at this different. So with that being said, I know everybody likes to buy things, especially on a day like today, and people say, Rob, you're the worst businessman in the world for not going in and selling anything. But the cold, hard reality is I don't want to sell you anything today. What I want to do is I want to get you to come watch me trade live Tuesday morning. That's also my birthday, by the way. So my birthday gift will be you guys going ahead and hanging out with me on my birthday. Let me teach you some more strategies. Let me go ahead and I'll celebrate my birthday with you. And if you guys go to becomeabettertrader.com/give, then yeah, I've had a lot of comments on Bitcoin. I'll be happy to talk about Bitcoin as well. On that day, I just did an interview on a radio program the other day on Bitcoin and futures, and JP Morgan's kind of flip-flop, from their situation where they were like, hey, we're going to fire anybody who trades Bitcoin, to now they're entertaining Bitcoin futures. So, I've been doing radio broadcasts, radio shows, and a featured speaker on different topics for Bitcoin. Happy to go ahead and do that. We won't be trading Bitcoin Tuesday morning, though. What we will be doing is focusing on equities and futures and stuff like that, answering some of your favorite questions. So if you go to becomeabettertrader.com/give, you can join me Tuesday morning. We'll send you an invite, and it'll just take you to this little page right here. It's going to be about 4 days and 17 minutes. So it's going to be right about 9 o'clock Central Time, 10 o'clock Eastern. It's coming Tuesday morning, and love to have you guys there, teach you more of these trading. I jammed as much as I possibly could here in just under 45 minutes, but there we'll have hours together, so I can teach you a lot more things, answer a lot more questions, look at a lot of different things for you. So it's the best Thanksgiving gift that I can give you guys here today for absolutely free. So, thank you very much. Well, hopefully I'll see you guys on my birthday here next Tuesday there. We'll go ahead and we'll do the trading room together, answer all your questions there. So, yeah, go to becomeabettertrader.com/give. And I tried to go ahead and keep this on time. I put the link in there for you as well. And so I'm looking forward to seeing. I think you guys will be pretty surprised when you see some of this live and in person. And I just showed you a real life example of how we use this to our advantage the other day to avoid a loss, then make a profit, and also determine areas of continuation on the daily charts, because when these were broken to the upside, led to great continuation moves, as we just showed on the daily chart. So pretty cool. So with that being said, with 1 minute to spare, I will turn it over to my friend Hubert so we can get us turned over to Serge and keep the whole program on time for you guys, because you guys got a lot of great people to hear from today. So thank you very much. I appreciate that. Thank you for the birthday wishes. Thank you for the Thanksgiving wishes. And you guys have a great day as well. BecomeAbetterTrader.com/give. We'll see you Tuesday. And you guys, thanks for being the world's greatest students. We'll see you in a few days. Bye-bye, everybody.